Hello, this is Victor Connor with your fall fourth quarter 2019 market outlook and plan. Following a difficult third quarter, we've entered the fourth quarter with a number of conflicting economic conditions. The four primary issues affecting the market: the economy, interest rates, China, and Washington. On the economy, unemployment is at 50-year lows for all groups. Job participation is at record highs. As a result of the employment numbers, wage growth is increasing across multiple sectors. Housing starts are picking up. GDP, while slowing, is still twice what it averaged before. Interest rates. The Federal Reserve's primary guidepost is inflation, and the Fed has a target inflation rate of 2 to 2.5%. However, inflation remains quite low, led by energy prices and technology-driven productivity. The Fed today is data-driven, meaning their interest rate policy is driven by inflation data. With the low inflation, the Fed needs to increase economic activity to boost inflation. The low inflation rate we've had over the last 2 years, mostly driven by low energy cost, is what caused the change from 4 potential rate increases to 2 rate decreases. Let's look at how energy prices affect you and everyone. 3 years ago, we were paying $4.50 a gallon for gas. Today, we're around $2.50 a gallon. Low gas prices help the lower end of consumers the most. When you have to drive to work every day, gas at $2.50 a gallon leaves a lot more in your pocket than gas at $4.50 a gallon. This puts more money, or leaves more money, in the consumer's pocket. And the consumer holds the key. Consumer spending makes up roughly 70% of GDP. With record unemployment, job outlooks remain strong and labor wages are increasing. The consumer remains strong. Next, the world's central banks, from China to Europe to the United States, are all working to stimulate their economies. And historically, it's rarely been successful to fight the world's banks. Therefore, with central banks around the world lowering or maintaining low interest rates, it's likely to be some time before this trend turns upward. On the negative side, yes, we're slowing down. The entire world is slowing down, which is what has inspired world central banks to adopt stimulative measures. Manufacturing is slowing down worldwide, but the service sector, which cannot be exported, remains strong and growing, and the consumer remains strong. Slowing is a natural event. After the tax cut of 2018, the economy and individuals got a boost. 2019 did not enjoy the same boost, so a slowdown could be expected. And a slowdown is much different than a recession. Yes, we're slowing down, but even the slower pace is still higher than the previous period. China. China remains a mystery. However, China is hurting from the tariff war more than the United States. A significant number of companies manufacturing in China have moved out of China, and others are looking for alternative sources as well. China knows once a company moves out, they're not likely coming back. So China has some very big problems domestically, more so than the U.S. And actually, a number of companies, including Apple as a bellwether, have announced plans to build back in the good old USA. Washington. The cloud hanging over all of this is the impeachment debacle. Washington is now in full stalemate. Nothing will get done while the impeachment process is played out. I won't begin to discuss the problems with the impeachment debacle, other than to say it appears that one party is more interested in their own political gain than improving the U.S. economy. Let's just leave it at that. Making investment decisions based on political events is the least successful method. Politics often literally change overnight, and rarely is there much logical progress. So, what do? How do you put this all together in some intelligent form? Well, With all these crises, what's the answer? I'll use a Chinese expression for this. The Chinese word for crisis signifies danger and opportunity, respectively. What is crisis to some is opportunity to others. In my opinion, the current crises present opportunities to those with a plan and a danger to those who just react. How do you turn crisis to opportunity? Start with a well-defined discipline and stick to that discipline. This is not, actually no time ever is, to make investment decisions based on emotions and short-term news. Don't invest based on the headlines. Remember, the headlines at this time last year was for 4 interest rate increases, and we all know what happened. Exactly the opposite. Given all the events outlined, the market has showed remarkable resilience in plowing through current events. For growth investors, buy quality companies with the bulk of their business in the United States. Almost all companies today have international exposure, yet we can still find businesses whose primary business is in the U.S. Quality and consistent earnings are key. Throughout this quarter, it's likely we'll see higher volatility than we've seen so far. With a discipline and a plan, use the volatility to pick up good quality companies at attractive prices. For income investors, in my opinion, the best place is quality dividend companies, from utilities to telecom to REITs to industrials. Look for companies with a history of raising dividends with consistent revenue streams. It's highly likely that interest rates aren't going to turn up anytime soon, so use this to your advantage. Those are our thoughts as well as our philosophy on our managed growth and dividend accounts. Please feel free to call us with your questions or concerns.